Namaste and welcome back to Smart Credit Bytes. I'm your host Sangeeta Sharma, MSME credit educator and former banker. In the last episode, we discussed why MSME often struggle with credit. Today, let's flip the lens and understand how does a banker actually think when evaluating your loan request. Because once you learn to think like a credit officer, your chances of approval increases dramatically. Ever wondered why your neighbor got approved for that loan while you didn't? Why banks say yes to some people and no to others? Today you will understand and the banking mindset so well you will practically predict their decisions. Here's the secret. Banks are not in the money business, they are in the risk management business. Every decision comes down to one question. How do we make money without losing our shirts? Let's go and check out. So, here are the 5 pillars of bank thinking. Banks evaluate every borrower using 5 key pillars. Master these and you will speak their language. The number 1 pillar is character. Are you trustworthy? They look at your payment history like a report card. One time payments for 2 years straight says reliable person. 3 missed payments last year says potential problem. Capacity. Second pillar is capacity. Can you actually afford this? They use your debt to income ratio. Make $5,000 monthly with $2,000 in your existing debt payments. They are wondering if you can handle another 1500 car payment, or most banks want your total debt under 36 to 43% of your income. Now the third pillar is capital. What's your safety net? Down payments. Down payments show you are serious and give you skin in the game. Saving account so you can weather emergencies without missing payments. Pillar number 4 is collateral. What can they recover if things go wrong? Houses, car, anything valuable they can repossess. Better collateral means better rate of interest. Now the fifth pillar is conditions. What's happening around you? Stable industry, good economy, strong neighborhood. External factors matter more than you even think. These 5 pillars determine everything. Think of them as your credit report card from the bank's perspective. Let's demystify that number keeping everyone up at night your credit score. Your credit score background like this number 35% is payment history. Do you pay on time? 30% consists of credit utilization. Using 80% of your credit limit red flag. Under 30% much better. 15% is length of your credit history. Keep old accounts open. 10% is types of credit. Mix of cards and loans looks good. And the 10% compromise of new credit. Don't apply for everything at once. But here's what most people miss. Banks don't just look at your score, they look at the story behind it. A 720 from someone managing 3 cards well is different from a 720 who just paid off collections. The sweet spots are 800 plus banks fights over you. If your score is 740 to 799, you will be offered excellent rates. If the score is 670 to 739, you will be having good rate from offer. And if your score is 580 to 669, higher rates but still possible. Below 580, it's your time to rebuild your credit history. Your score is not a judgment of your worth. It's just a tool and tool can be improved. Now we will talk about what's bank love versus what bank hate. Let's talk about what makes banks excited versus what makes them run away. So banks love stable employment, 2 plus years, same job or industry, low debt to income ratio, lots of breathing room, long banking relationship, they know your habits, conservative credit use, using 10% of your available credit, not 90%. Regular savings habit, even $100 per month shows discipline. Now, what banks hate most? Recent late payments, especially in the last 12 months. High credit utilization, maxed out your cards, scream desperation. Too many recent credit application looks desperate or suspicious. Inconsistent income, they can't predict your ability to pay. Lies on application, they verify everything. Here's the good news, most red flags can be fixed with time and the right strategy. Bank want to say yes, they make money by landing the people who pay them back. So, in my next section, I will be revealing the application process. Here's what actually happens and when you apply. Automated screening checks. Your basics and seconds don't mean minimums rejected before human review. Second step is credit report deep dive. An underwriter plays detective looking for patterns and explanation. Step 3 is income verification. They don't take your word. They check with employers, ask for payment and bank statement. Chapter 4 human decision time. Step 4 is human decision time. The underwriter weighs everything against bank policy and their experience. Now the step 5 is the counter offer. Can't get $25,000, they might offer you $15,000 instead of just saying no. So the pro tips from my desk is be prepared with documents, be honest and be patient. Good underwriting takes time. Some of the insider strategies that work. Now for the strategies that come from understanding how banks think. Relationship banking. Apply where you already bank. Suppose your salary account is in say XYZ bank. There are much more chances to get your loan faster and with less documentation in XYZ bank than you go for ABC bank. Existing customers always get better deals because the bank knows and trusts you. Second is perfect timing. Apply when you are financially strongest, right after a raise, after paying off debt, when your ratios look best. Pre-approval power. Get pre-approved before shopping, so sellers you are serious and tells you exactly what you qualify for. Credit utilization hack. Keep users under 30%, ideally under 10%. You can improve this by paying down balances or requesting credit limit increases. Smart application process. For mortgages or car loans, do all application within 14 to 45 day window. Multiple apps for same type of loan count as in one inquiry. Build gradually. Start small, succeed, then grow. One good credit card managed well beats 5 cards you are struggling with. So my next is what should be your action plan? So I will suggest here's what to do right now. This week you check your credit reports, calculate your debt to income ratio, review your credit utilization on all cards. For next 30 days, set up automatic payments. This will ensure that you never miss another payment. Pay down high utilization cards which are below 30%. Gather financial documents. And for next 30 days, build banking relationship where you want to borrow. Fix any credit reports error. Start an emergency fund. Even 1,000 will help. Long-term goal should be focus on your income growth. Diversify your credit mix thoroughly and thoughtfully. Plan credit application strategically. So, here you have it all. You now understand that banks are not your enemy, they are managing business risk. When you understand what they want, you can become the kind of customer they are excited to work with. Remember, banks want to say yes, they make money by lending to people who pay them back. Position yourself as that reliable person and doors will open. The key takeaway is building credit is like going to the gym. It's not about one perfect day, it's about consistent, healthy habits over time. If this episode helped you see the loan process with new eyes, share it with a fellow MSME owner or a finance student. Smart Credit Byte is here every Monday and Thursday, simplifying the world of MSME finance for real world growth. Until next time, learn, grow, and get credit ready with Sangeeta Sharma. Thank you.